There is a particular kind of silence that settles over an investor staring at a number that has fallen 40% from its peak. It is not quite grief. It is not quite panic. It is something more unsettling than both. A creeping suspicion that the story you believed in so completely, the one that made so much rational sense on so many evenings when you sat down and read the data, was perhaps not the story you thought it was. Silver is sitting near $73 today, May 5th, 2026. 4 months ago, on January 29th of this year, it touched $121.64. That was an all-time nominal high, a number silver had never once reached in its entire recorded trading history. And now it has surrendered nearly half of that extraordinary achievement, and the question hanging in the air, unspoken but deafening, is this: is the story over? Let me tell you something that history knows far better than today's financial press. Stories like silver's do not end quietly at chapter breaks. They end, when they end at all, with the fundamental arithmetic changing. And the fundamental arithmetic has not changed. Not one variable, not one number. What has changed is a chain of geopolitical events, each one real, each one painful, and each one temporary, built entirely on the closure of a narrow passage of water in the Middle East that has concentrated more anxiety per nautical mile than any geographic feature on Earth. The Strait of Hormuz closed, oil climbed from the low 70s toward and above $100 per barrel. Inflation expectations rose with it. The Federal Reserve abandoned any near-term appetite for cutting interest rates. The dollar strengthened as capital chased yield into American bonds paying roughly 4.25% annually. And silver, which pays no interest, no dividend, and carries no yield, found itself at a short-term competitive disadvantage to Treasury instruments. That is the entire mechanical explanation for the correction. A sequence of causes, each identifiable, each connected, each traceable back to a single event-driven origin. And when you can name the cause of a correction that precisely, you are no longer looking at structural collapse. You are looking at a temporary repricing. To understand what silver's position actually is, and why that position is more compelling than a chart descending from $121 to $73 would seem to suggest, you need to understand what drove it from $12 in early 2020 to that all-time high. Over 5 years, silver appreciated approximately 1,000%. That is not a number that emerges from speculation alone. Speculation amplifies, speculation accelerates, but 1,000% over 5 years in a physical commodity reflects something real underneath. What is real underneath silver is now in its 6th consecutive year of a structural supply deficit. The Silver Institute, which publishes the authoritative global survey of silver supply and demand, has confirmed that the world in 2026 will consume approximately 46.3 million more ounces of silver than all the mines on Earth will produce. That is not a forecast with political motivations. That is arithmetic applied to confirmed production figures and confirmed industrial orders. And it is the 6th year in a row that the arithmetic has arrived at the same uncomfortable conclusion. The cumulative shortfall from 2021 through last year exceeded 800 million ounces. Those ounces came from somewhere. They came from vaults, from exchange inventories, from above-ground stockpiles that accumulated over decades and are now being drawn down year after year with no mechanism in place to refill them on any timeline that matters to a human investor. The supply side of that equation is not going to correct itself. Approximately 70% of the world's silver comes out of the ground not because anyone was mining for silver, but because copper miners and zinc miners and lead miners extract silver as a byproduct of chasing their primary metals. The decision to produce more silver cannot be made by silver producers responding to silver prices, because most silver is not produced by silver producers. It is produced by base metal operations whose capital allocation decisions are made based on copper demand and zinc forecasts. And the mines that are specifically developed for silver take, on average, 7 to 10 years from discovery to first production. Not months, not a market cycle, a decade. The correction from $121 to $73 did not open a single new mine. It did not accelerate a single development timeline. It did not add 1 ounce to the above-ground supply. It only changed the number on the screen. The physical reality underneath that number remained entirely unmoved. Before we go any further, if you have found this kind of clear-eyed, data-rooted analysis useful, the kind that does not shout or panic or pretend that watching a number fall 40% is emotionally simple, subscribe. Not because this channel needs the number, but because the analysis that follows in the coming weeks, as the Hormuz situation develops, as the May 12th CPI print arrives, as the new Federal Reserve Chair takes his first press conference, will matter enormously to anyone trying to hold a correct thesis through a genuinely difficult correction. You will want to be here for that. Subscribe now and let us continue. Now, the thing that most people get wrong about corrections inside commodity bull markets is not the mathematics. Most people, if you sit them down with a spreadsheet, can follow the supply deficit numbers perfectly well. What they cannot do, what almost no one does well, is hold the right framework at the right moment when the chart is ugly and the mainstream commentary is unkind, and the paper price has diverged from the physical reality far enough that the gap begins to feel like a verdict rather than a temporary dislocation. The mainstream financial press has not been writing encouraging things about silver at $73. The voices that were most prominent when silver was at $121 have largely gone quiet, or worse, have pivoted to explaining why the correction confirms their earlier skepticism. This is the texture of every significant chapter break inside every major commodity bull market in recorded history. It felt exactly this way in 1976, when silver fell approximately 50% from an intermediate peak before beginning the run that would take it to $49.50 by January 1980. It felt exactly this way in 2008, when silver fell from $21 to $8 in 5 months, a 60% collapse, before recovering to those same $49 highs in 2011. The people who sold in 2008 during that 60% drawdown were not irrational. They were responding to the information available to them, which made the situation look extremely bad. They were simply wrong about which story was ending. Today's correction, from $121.64 in January to roughly $73 this week, is approximately 40% from peak. Against the documented history of silver bull markets, that is within the entirely normal range of corrections that occurred during, not despite, the largest sustained appreciation periods the metal has ever produced. It is painful because volatility is always painful in the living of it, but measured against the historical record, it is not an outlier. It is the pattern. The gold to silver ratio today sits at approximately 63-1. Gold is trading near $4,580 per ounce as of this week. That means it takes 63 ounces of silver to purchase 1 ounce of gold. The geological ratio of silver to gold in the Earth's crust is approximately 8-1. The market has always discounted silver relative to its geological abundance because much of it is mined as a byproduct at industrial scale. But in peak physical tightness cycles, when monetary uncertainty reaches genuine crisis levels, that ratio has historically compressed with remarkable force. At the 1980 peak, it reached 17-1. At the 2011 peak, it reached 32-1. If gold, driven by a dollar debasement scenario supported by a national debt now exceeding $38 trillion, and annual interest payments approaching $1 trillion annually, on their way to $2 trillion by the mid-2030s, reaches $10,000, and if the gold to silver ratio compresses only to 30-1, still nearly 4 times the geological ratio, still historically conservative, silver would be priced at $333. If the ratio moves to 20-1, matching the 2011 compression, silver sits at $500. These are not projections built on optimism. They are mathematical outputs of specific conditions applied to documented historical patterns. 2 of the 3 conditions necessary, currency debasement pressure from sovereign debt trajectories, and mine supply that structurally cannot respond, are already confirmed facts. The third, industrial demand acceleration from artificial intelligence infrastructure, solar manufacturing, and electric vehicle production, is also confirmed. Meta, Alphabet, Microsoft, and Amazon alone have committed $715 billion in capital expenditure to data center infrastructure in 2026. Each of those facilities uses silver in its electronics, its power distribution systems, its cooling infrastructure. And because silver represents less than 1% of a data center's total construction cost, the demand is effectively price insensitive. These companies are not modifying their build plans because silver costs $73 instead of $100. They are building what they need. The correction happened because of oil. Oil happened because of Hormuz. Hormuz is a geopolitical event with a diplomatic pathway toward resolution, however slow, however uncertain. Iran has sent a revised 14-point proposal. The White House has signaled it is reviewing the terms. The situation is not resolved, but it is not irreversible. The chain that produced this correction, oil above $100, inflation above 3%, the Fed on hold, the dollar strengthened, silver's paper price suppressed, runs in reverse when the condition that started it begins to ease. When oil falls below $95 on any sustained basis, the inflation calculus shifts. When inflation data softens, rate cut expectations return. When rate cut expectations return, the dollar softens. When the dollar softens, silver, priced globally in dollars, becomes less expensive for international buyers. The paper market, which pushed the price down through a specific mechanical sequence, pushes it back up through the same sequence run backward. Not gradually, as commodities like silver tend to move, in bursts, quickly, in ways that do not wait for confirmation. There is an insight in long-term commodity investing that is extraordinarily simple to state and extraordinarily difficult to actually execute. It is the difference between understanding the structure of a market and being able to hold that understanding under the specific emotional conditions that a 40% correction produces. Most people, even those who can recite the supply deficit numbers fluently, even those who understood exactly why silver went from $12 in 2020 to $121 in January, are still fundamentally thinking in short-term terms when the correction comes. They are asking whether they should have sold at the peak, whether $73 is the right place to accumulate, whether it might fall further before it recovers. Those questions feel reasonable. They are built on one assumption that almost never holds in volatile commodity markets: the assumption that you can consistently time the turning points with enough precision to matter. History does not support that assumption. What history does support is the observation that in structural commodity bull markets, the largest gains accrue to investors who understood the thesis clearly enough to hold through the corrections without abandoning their position, and then hold a little longer after that. The people who built extraordinary wealth in silver from 1971 to 1980 were not the people who bought at the exact bottom of every correction. They were the people who understood that the monetary conditions of that decade, sovereign debt growing faster than the economy could absorb it, inflation running persistently above what central banks could cleanly contain, industrial demand from a modernizing global economy, made the physical supply of silver structurally insufficient. And they held that understanding through corrections of 30 and 40 and even 50%, because they could clearly see the difference between what was causing the correction and what was driving the underlying bull market. The 1976 50% correction did not change the monetary dynamics of the 1970s. The 2008 60% crash did not change the global solar and industrial demand trajectory for silver. The current 40% correction has not changed the sixth consecutive year of supply deficit. It has not changed the 7 to 10 year minimum timeline before any new mine supply reaches the market. It has not reduced the capital expenditure commitments of the four companies alone, spending $715 billion on the infrastructure that uses silver inelastically. It has not changed the trajectory of a national debt that adds approximately $1 trillion in new interest obligations to an already burdened balance sheet on a path that most serious analysts describe not as sustainable, but as managed through gradual currency debasement. 3 specific things to watch this week and in the weeks ahead. Watch oil before you watch silver. Brent crude is the master variable in the current environment. Below $95 on any sustained basis shifts the inflation calculus toward Fed flexibility. Above $105 reimposes the pressure that has held rates elevated in the dollar strong. Watch the CPI release on May 12th. If April's inflation data shows that the energy component is beginning to ease, that the March oil spike is showing up as a moderating factor in the headline numbers, rate cut expectations return into the conversation and silver responds immediately. Watch the $72 level on silver itself. It has been tested and held multiple times. A fourth hold would represent one of the strongest technical signals of this correction. A daily close below $70, which has not occurred yet, would require a reassessment of the near-term picture. And watch Kevin Warsh, the incoming Federal Reserve Chair. His first public statement on the rate path will be one of the most consequential monetary policy moments of 2026 for anyone holding silver or gold. Here is where the entire argument resolves. Silver at $73 is silver priced as though the long-term structural story might not be happening. The world's paper market, responding to oil prices and rate expectations and dollar strength, has temporarily run away from the physical reality of a commodity that the world consumes faster than it produces, in a sixth consecutive year of deficit, with no supply response available for the better part of a decade. That divergence between paper price and physical reality has occurred before, in both directions, and in every prior instance, the resolution moved toward the physical reality. Because you can create more paper contracts, you cannot create more silver. The correction tested the thesis. The thesis passed. The supply deficit is real. The demand is inelastic. The monetary environment is structurally supportive of hard assets in ways that do not disappear because the Strait of Hormuz is temporarily closed. The correction is a chapter break. The story is intact. Now, there is one thing I want from you before you go. Not a subscription, not a share, though both are welcome. I want you to think honestly and drop your answer below. Has this correction changed your conviction in silver's long-term story? Or has understanding the cause of it actually strengthened it? One line in the comments is all it takes, and the conversation that follows matters more than anything I can say in a single video. Your perspective, your reasoning, your doubts, and your convictions, that is where the real thinking happens. Tell me where you stand. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind.